If you have been watching the silver market lately, you know things have been moving fast, but what happened over the last few hours is something we haven't seen in our lifetime. As the markets opened for Monday trading in Asia, silver prices on the Shanghai Futures Exchange didn't just climb, they exploded. Right now, silver is trading at roughly $125 per ounce in Shanghai. Meanwhile, back here in the United States, the COMEX price is sitting closer to $110. That is a $15 to $17 difference between the two markets. In professional trading, we call this a premium, but a gap this large is more like a structural break. It means the system that usually keeps global prices in sync is starting to fail. While most of America was still asleep, Asian markets added $6 to the price in a matter of 2 hours. This isn't just a simple rally. This is the physical market in the East screaming at the paper market in the West that the old rules no longer apply. If you hold physical metal or you are watching these markets for your retirement, you need to understand exactly what is breaking and why. The problem with arbitrage. In a normal, healthy market, a $17 price gap shouldn't exist for more than a few minutes. Theoretically, a trader could buy silver in New York for $110, ship it to Shanghai, sell it for $125, and pocket a massive profit after paying for shipping and insurance. This is called arbitrage. The fact that this gap is staying open tells us two very important things. First, physical silver is likely not available in the quantities needed to move that much metal. Second, the logistics and regulations involved in moving silver are failing to keep up with the demand. Either way, physical metal is not moving freely across the globe. This premium in Shanghai isn't a fluke. It has been building for months. China has been tightening its grip on critical metals, limiting exports, and building up its own strategic reserves. What we are seeing in Shanghai is true price discovery. They are discovering that physical silver in Asia is worth significantly more than the paper contracts being traded in New York or London. Where is the metal going? To understand why the West is losing its grip on the silver price, we have to look at the inventories. We have been tracking the registered silver on the COMEX for a long time. This is the silver that is actually available to be delivered to people who hold futures contracts. That inventory has been trending down for months. Every time there is a surge in demand, more silver is pulled out of the vaults or reclassified so it can't be sold. Meanwhile, the open interest, the number of people holding paper bets on silver, remains high. Shanghai is essentially deciding to ignore the Western paper price. They are saying they will pay whatever is necessary to get real physical metal in their hands. This is a legitimate move driven by institutional and sovereign-level buying. This isn't just a few retail traders on an app. This is the world's largest manufacturing economy realizing they need silver to function. Why China is willing to pay more. You might wonder why a manufacturer in China would pay $125 when the official price in the West is lower. It comes down to one word: necessity. Silver is no longer just a precious metal used for coins and jewelry. It is a strategic industrial material with no substitute. You cannot build a modern solar panel without silver. You cannot manufacture high-efficiency electronics or 5G infrastructure without it. As the world pushes for a green energy transition, the demand for silver is skyrocketing. China is the global hub for solar panel and electric vehicle manufacturing. If they run out of silver, their factories stop. They have clearly decided that having the metal at $125 is better than having a paper contract at $110 and no actual silver to show for it. The geopolitical shift. This price gap is also a symptom of a world that is fragmenting. For decades, we lived in a world where supply chains were global and metal moved easily from one country to another. That world is disappearing. We are now in a race to secure critical materials. Last year, China started putting export controls on various metals. At the same time, the United States is trying to bring manufacturing back home. When supply chains break down along political lines, a global price for silver becomes impossible to maintain. If Chinese buyers are desperate for supply, or if they know something about future shortages that we don't, they will pay a premium to lock in what is left. This Shanghai price action might be the first sign that the West is about to face a massive repricing. The institutional reality check. One of the most interesting parts of this story is who is not in the market yet. Most Western hedge funds, pension funds, and large institutional investors have been ignoring precious metals for years. They have been underweight in gold and silver, preferring to stay in tech stocks or bonds. If the price action in Shanghai forces these Western funds to pay attention, we could see a massive wave of money move into the market. If American funds start buying silver futures to hedge against a shortage, the COMEX inventories will drain even faster. If the New York and London markets can't meet that delivery demand, the premiums on physical coins and bars here at home will start to climb even higher. We could reach a point where the paper market loses all credibility, and the only price that matters is the one you pay to actually hold a silver bar in your hand. Is this a flash in the pan? Now, it is important to look at the other side of this. Could this price gap close tomorrow? It is possible. In professional trading, you have to stay disciplined. If this spike in Shanghai is just a temporary short squeeze or a technical issue with one exchange, the premium could vanish as quickly as it appeared. We have seen flash premiums before that didn't last. Also, the people who manage the paper markets in the West, the big banks and the regulators, have deep pockets. They can raise margins or halt trading to try and suppress a rally. They have been doing it for decades, and we shouldn't underestimate their ability to put a lid on the price. There is also the risk of profit-taking. Traders who bought silver when it was at $90 are looking at huge gains right now. The temptation to sell and lock in a 20% profit can be strong, and that selling pressure could stall the rally even if the physical shortage is real. However, the reason many are leaning toward the bullish case is that this isn't happening in isolation. We are seeing a convergence of factors: declining inventories in New York, flat inventories in London, and central banks buying gold at a record pace. The $17 premium is just the most visible sign of a supply crisis that has been building under the surface for a long time. When a market disconnects like this, it is more than just a trading opportunity. It is a sign that the old world of silver pricing is losing its grip. For decades, the price of silver was determined by paper contracts traded in New York and London. If you wanted to know what silver was worth, you looked at the COMEX. But as of January 2026, Shanghai is effectively saying that those paper prices are a fiction. If the West wants to play games with paper contracts, they can. But in the East, where the manufacturing actually happens, the physical metal is what matters. This is the beginning of what many are calling a global silver reset. The paper market is reaching a breaking point. We have to be honest about how the Western markets work. The COMEX and the LBMA rely on the assumption that most people will never actually ask for their silver. They trade paper promises back and forth, and as long as only a small percentage of people want physical delivery, the system stays stable. But when you have a $17 premium in Asia, that stability disappears. If the COMEX tries to keep the price suppressed at $110, while the rest of the world is paying $125, the inventories in New York will be drained until there is nothing left. You simply cannot maintain a massive price difference for long when the underlying asset is as critical as silver. If the New York and London markets don't have the metal to deliver, the entire paper pricing structure starts to crack. We may be watching the early stages of a move where the physical market finally takes the steering wheel away from the banks and the regulators. Validation for the stackers. For those of you who have been holding physical silver, the stackers, this moment is a huge validation of your strategy. For months, you have been paying premiums over the spot price at your local coin shop. You might have felt like you were being overcharged when a dealer asked for $10 or $12 over the screen price. But as we can see from the Shanghai markets, those premiums weren't just dealer markups. They were the market trying to tell you that the spot price was wrong. Physical metal is worth more than a promise on a screen. Now, the biggest manufacturing economy in the world is confirming that at the sovereign level. If you are holding coins and bars, you aren't just holding a speculative asset. You are holding a strategic material that the world is starting to realize is in short supply. The bearish case: keeping our feet on the ground. I wouldn't be doing my job as a friend and an analyst if I didn't talk about the risks. Markets that move this fast can be very dangerous. Silver is notoriously volatile, and if you aren't prepared for a $20 swing in either direction, you shouldn't be in this market. There are a few things that could cause this rally to stall or even reverse in the short term. Exchange intervention. The COMEX has a lot of tools at its disposal. They can hike margin requirements, which forces people to sell their positions. They can even change the rules so that contracts are settled in cash rather than metal. They have deep pockets and deep connections, and they won't give up control of the price without a fight. Profit taking. A lot of traders bought silver when it was much lower. When you see a 15% move in a single day, the temptation to sell and lock in those gains is huge. That selling pressure could cause a temporary dip, even if the long-term supply problem is real. Macro shocks. If the Federal Reserve comes out with an unexpectedly hawkish stance, or if we see a sudden risk-off event in the stock market, silver often gets caught in the crossfire. In a liquidity crunch, people sell what they can, not just what they want to. Why this time feels different? Despite those risks, the bullish case is stronger than it has been in decades. The Shanghai premium is the visible symptom of a supply crisis that has been growing for years. Think about the sheer scale of the demand. The solar build-out in China alone requires hundreds of millions of ounces every single year. Then you have the AI revolution. Every high-performance data center being built by big tech needs silver for its components. These are not optional uses. A company like Tesla or Apple isn't going to stop production because silver went up $10. They will pay whatever they have to pay to keep their lines moving. When you combine that non-negotiable industrial demand with the fact that global inventories are at multi-year lows, you have a recipe for a permanent repricing. The 3 key takeaways. As we wrap up this emergency update, here are the 3 things I want you to remember. 1. The price gap is a signal. A $17 disconnect between markets is not normal volatility. It is a sign of a structural supply issue that the paper markets can no longer hide. 2. Credibility is at stake. If this gap persists, the Western paper markets will lose their role as the price setters for the world. We are moving toward a system where physical availability determines the price. 3. The supply crisis is structural. This isn't just a hype rally. The convergence of industrial needs, geopolitical stockpiling, and draining vaults means that higher prices alone won't solve the shortage quickly. What should you do next? If you are long on silver, stay sharp. Make sure you know where your stop-loss levels are, and don't get over-leveraged. If you are a stacker, understand that the spot price you see on the news is becoming less relevant every day. The value of your metal is determined by what someone is willing to pay to actually hold it. Watch the registered inventories on the COMEX this week. Watch to see if the New York prices start to chase Shanghai or if the gap widens. We are watching history unfold in real time, and the battle between paper promises and physical reality is reaching a boiling point. Invest with logic, stay informed, and don't let the noise distract you from the fundamentals.